Hey everyone, welcome to this explainer. Today we're going to completely demystify the invisible forces acting on your money right this very second. If you've ever stared at your bank account and felt totally overwhelmed by where your cash is going, or honestly, how to actually make it grow, you are in the exactly right place. By the time we wrap this up, we're going to shift you from feeling overwhelmed to completely empowered.
Here's a quick look at our roadmap today. We'll cover the cost of civilization, where your money lives, the invisible economic forces, borrowing, trust, and rent, and finally, making your money multiply.
All right, let's dive into Section 1, the cost of civilization and where your paycheck goes. Okay, so picture this. You've been slaving away all month. Maybe you're flipping burgers or just grinding at the office and you are exhausted, right? Then you get that glorious email notification from payroll saying you earned $2,000. Amazing. But then you check your bank account and the deposit is only $1,456. Ouch. This just perfectly captures the visceral pain of this modern financial ritual we all go through. You're giving away a massive chunk of your hard-earned money to these invisible forces, and somehow we're just expected to say thank you. You're probably scrolling down your pay stub thinking, literally, where did it all go?
Well, it went here. You've got federal income tax hitting the money you make, sales tax taxing the money you spend, and capital gains tax hitting the money your investments make while you sleep. Here's the deal, though. Taxes are, essentially, the cost of civilization. I mean, they make sure your favorite local taco truck isn't infested with rats, they fund our schools, and yeah, they pay for billion-dollar missiles to places you've never even heard of. You'll also see Social Security on there, which is basically the government forcing you to save for your own retirement so they can slowly pay it back to you later. And oh, let's not forget the absolutely bizarre annual guessing game of filing taxes. Where the government knows exactly what you owe, but makes you guess anyway? And if you guess wrong, well, you're cooked.
Moving on to Section 2, where your money lives and the bank middleman. So, what actually happens to that remaining $1,456? You probably picture it sitting in some giant, shiny vault guarded by a dragon, right? Well, not quite. Banks are basically just middlemen engaging in what's called fractional reserve banking. When you deposit your money, they only keep a tiny, tiny fraction of it on hand. They immediately turn around and lend the rest of it out to someone else who, wants to buy a jet ski. In this setup, you're the supply, and that borrower is the demand. And this whole system relies entirely on the assumption that not everyone is going to ask for their money back at the exact same time. It's a system that works perfectly. Well, unless it's 2008 and everyone lines up at once, causing the whole thing to kind of crumble.
But hey, don't panic, because of this incredibly heroic number right here, $250,000. In the US, this is the FDIC insurance limit. The government is basically stepping in to assure you that no matter what happens to the bank, your money, up to $250K, is completely safe. Banks use this guarantee of safety, along with the convenience of debit cards and the promise of a little bit of interest, to entice you into keeping your cash with them instead of, stuffing it inside a shoebox in your closet.
All right, Section 3, the invisible economic forces. Let's talk about interest, inflation, and recessions.
Now, what's really interesting here is the incredible duality of interest. Simple interest is pretty straightforward. It's just a flat fee, kind of like a thanks for playing charge. But compound interest? Oh man, that is when every dollar you have makes clones of itself, and then those clones want to collect rent too. It's wild. Like if you owe 20% interest on a credit card and miss a payment, that interest starts earning interest against you. Suddenly, your $12 burrito turns into a $50 regret. On the flip side though, investing at a 7% annual compound rate acts like an absolute cheat code. Your money just duplicates itself over and over until one day you wake up older, rich, and maybe just a little bit smug about it.
So it all boils down to this quote right here. Interest is money's way of charging rent to exist in someone else's hands. When you're the one borrowing, it is the incredibly painful price tag for using someone else's cash. But when you lend or save, it's the beautiful reward for being patient. Ultimately, interest is either going to be your absolute worst enemy or your best unpaid employee. The only difference is who's collecting it.
But what if your money is just sitting perfectly still? Enter inflation. Inflation is the slow, quiet erosion of your money's value. Your $5 bill is still physically a $5 bill, but suddenly it buys way fewer instant noodles and a lot less gas. So how does this actually happen? Look at this self-fulfilling cycle. Step 1, people have too much cash and they really want to spend it. Step 2, there are limited goods out there. Imagine 2,000 people all trying to buy the exact same 1,000 TVs. So step 3, businesses naturally raise their prices to cool off that demand. Sometimes, honestly, just the expectation of inflation makes people spend faster, which drives prices up even more. To fight this, the government has to step in and raise interest rates to make borrowing expensive, forcibly cooling down all our spending.
And, well, sometimes cooling the economy down leads us straight into a recession. Think of the economy like a massive house party. In year 1, we're in the boom phase. Everyone's dancing, the drinks are flowing, it's great. By year 3, we hit the absolute peak of the party. But by year 4, the lights start to flicker, reality hits, someone actually checks their bank account, and suddenly we are in a bust. Jobs vanish, companies aggressively cut costs, and the DJ is just playing sad lo-fi beats. Recessions are definitely painful, but they're really just resets. They're usually caused by high interest rates, global crises, or supply chain hiccups. Eventually spending returns, and we hit the reset button in year 5.
Moving on to Section 4, Borrowing, Trust, and Rent, Playing the Credit Game.
Now, before we even talk about borrowing, we have to remember that currency itself is really just a regulated social construct. I mean, there's no actual physical legitimacy that makes a dollar bill inherently more valuable than a random stick you found outside. We've just collectively agreed as a society to trust that a dollar has value. And speaking of trust, when you want to borrow this socially agreed upon money, lenders rely entirely on this construct of trust, which they measure by a number range 300 to 850. This is your credit score. If you're sitting down below a 580, you're basically a walking red flag to lenders. But if your score is over 750, you are sparkling with adult credibility, and banks will literally be lining up to lend you cash.
So, how do they get that number? Your score is calculated by the Shadowy Algorithm that looks at factors like your payment history, your credit utilization, and your credit age. And here's the kicker. This score does not measure your actual wealth at all. You can have zero debt and still have a terrible score. It purely measures trust. Honestly, think of your credit score kind of like a pet dog. If you ignore it, it's going to poop all over your life, denying you a house or hitting you with soul-crushing interest rates. But if you actually take care of it, it unlocks the whole game. And yes, the game is totally rigged, but if you learn these rules, you can absolutely rig it right back in your favor.
Which brings us to Section 5, Making Your Money Multiply, the Ultimate Cheat Codes.
Okay, so we know inflation is out there actively trying to steal your future value. The only real way to rig the game in your favor is to invest. That means your money stops just sitting around on the couch and actually starts working for you. Here are the main vehicles to make that happen. Stocks give you tiny ownership slices of a real company. Bonds are basically when you loan your money to a government or a corporation, and they promise to pay you back with interest. Funds are just collections of these things, so you don't have to stress about picking and choosing individual winners. And real estate is property you buy, with the hope that someone else pays to live in it. Remember, the biggest risk you face isn't that markets occasionally drop. No, the real danger is never investing at all and letting inflation slowly eat your savings alive.
But you might be wondering, why do these things actually grow in value? Well, it all comes down to human perception. An average rock is, just a rock. But a shiny, yellow rock like gold, we perceive that as rare, so humans value it way more. Same thing with fashion. A Target handbag and a Gucci handbag might hold the exact same stuff, but Gucci commands 100 times the price purely because of perceived brand value. When Steve Jobs created the iPhone, he provided massive value to society, so millions of people practically threw their money at him. If you want to build immense wealth, you really have to learn how to create and provide massive value to others, whether that's through your specific skills or your investments.
But hey, even if you don't invent the next iPhone, you still have the ultimate secret weapon on your side: time. Time is literally the greatest wealth multiplier in existence. Top earners don't just trade 1 hour for 1 paycheck. They use skills, leverage, and time, so their hours constantly work for them. In investing, wealth isn't built in days, it's built in decades. Modest, consistent investments don't just grow, they multiply. It happens slowly at first and then incredibly fast, which is exactly what allows completely ordinary people to eventually retire with 7 figures in the bank.
Which brings us to our final and maybe most powerful takeaway for this explainer. A little money invested consistently, given enough time, becomes a lot. Guys, you don't need to be lucky, and you don't need to try and beat the financial system. You just need to use it. Now that you actually understand the rules of the game, from taxes and fractional banking to compound interest and the sheer power of time, the ball is officially in your court. So I'll leave you with this question to think about today. Is your money just sitting there quietly eroding away, or are you finally going to put it to work for your future?